I'm currently buying the dip in Netflix stock in my eToro portfolio, and in today's video I'm going to show you the reasons why. We'll look at why Netflix stock is falling so dramatically, Netflix's business model, their competitive advantages, and of course we also have to assess the risks surrounding the company. Firstly, let's look at the headlines to learn why Netflix stock is in such a mess right now. On December 5th, Netflix announced it had agreed a $72 billion deal with Warner Bros. Discovery to acquire their streaming and studio assets. These assets include Warner Bros. Studios, HBO and HBO Max, DC, and their content library. This excludes Warner Bros. Cable networks that are expected to be spun off into a different company. However, just 2 days later, on December 8th, Paramount launched an all-cash hostile takeover bid of $108 billion, roughly $30 per share, for the entirety of Warner Bros. Discovery, which includes the cable networks. In the following days, political and industry backlash intensified as US President Trump and Senator Mike Lee raised antitrust concerns around the deal, which led many investors to flee Netflix stock. Now we're going to look at Netflix's business model to see why I think it's one of the highest quality stocks around. Netflix is one of the largest video streaming services in the world, with roughly 8% of global TV viewing. With over 300 million paying subscribers, Netflix has one of the strongest network effects in the industry. When a show is a hit on Netflix, everybody hears about it because their 300 million subscribers spread the word to friends and family, and they also spread the word on social media. The only other streaming platform with this kind of reach is YouTube, which benefits from mostly user-generated content, whereas Netflix spends roughly $15 billion a year on professionally produced content for its users to consume. The content budget is their main expense, making up roughly 40% of revenue, with less than 2% of revenue spent on capex, making the business capital light from a financial perspective. Their other expenses like sales and marketing, research and development, and general and administrative account for roughly 20% of revenue, leaving a healthy operating margin of 28%, which is a massive increase from just 3% 10 years ago, showing incredible operating leverage and secular margin expansion, which I expect to continue as the company increases operating efficiency and, more importantly, raises prices over time at roughly twice the rate of inflation, which all trickles down to the bottom line, creating an outsized impact on profit and free cash flow. Now let's take a look at Netflix's competitive advantages. These are the qualities that allow Netflix to gain market share and keep competitors at bay over the long term. Firstly, Netflix has an iconic brand with industry-leading customer loyalty. The company's churn, the rate at which subscribers cancel their subscriptions, is around 2 to 3%, which is low when compared to rival streaming services like Disney Plus at around 5%. Low churn is advantageous because it means customers stay longer, generating more lifetime value, lowering acquisition costs, and allowing revenue to compound more efficiently. In subscription businesses like Netflix, low churn is one of the strongest signals of loyalty and sustainable growth. Scale is also a huge competitive advantage for Netflix. With over 300 million subscribers, the amount of data they're able to leverage to improve their algorithms is immense. This data can be used for personalization, improving recommendation systems, and now targeted advertising, which will be more accurate and therefore more profitable on a per user basis. Another major advantage is Netflix's impressive content development and increasingly valuable IP or intellectual property. As mentioned before, Netflix invests roughly $15 to $20 billion on an annual basis to produce its originals like Stranger Things, Squid Game, and Wednesday. This proprietary IP allows monetization opportunities beyond streaming, for example, video games, merchandise, and live events. Netflix's global reach is also a huge advantage. Their service is available in 190 plus countries with tailored pricing and local language content, which increases perceived value in these countries. As smart long-term investors, we also have to discuss and analyze the risks that could affect the business in the future so that we're not caught off guard by any negative developments. The most obvious risk to start off with is the Warner Bros. Acquisition. Netflix is financing the $72 billion deal with a $59 billion bridge loan, raising concerns about debt. However, Netflix now produces significant free cash flow, around $9 billion in the last 12 months, which is enough to pay off the acquisition debt in full in less than 7 years. But that's without accounting for the growth in Netflix's free cash flow, which I expect to reach around $20 billion by 2030. And then if you include the free cash flow produced by the assets acquired from Warner Bros., we could see Netflix's free cash flow reach upwards of $25 billion by 2030, which could pay off the entire debt burden in less than 3 years. Another major risk is escalating content costs. As competition heats up in streaming, the scarcity of premium IP increases acquisition cost. However, Netflix's content budget has actually fallen in recent years from a peak of around $18.6 billion in Q2 2022 to $16.5 billion in Q3 2025. This is evidence of Netflix's operational efficiency. Despite lower content spend, revenue has continued to grow at roughly 15% annually. Furthermore, the Warner Bros. Acquisition is essentially front-loaded content spend, meaning Netflix can use the IP from Warner Bros. To expand its content offerings, allowing them to control content costs more effectively. The other major risk is regulatory policy. If the Warner Bros. Acquisition is blocked by regulators, Netflix will have to pay Warner Bros. A huge $5.8 billion breakup fee. This is probably the most concerning risk because it would essentially fund a competitor, reminiscent of what happened when Adobe tried to buy Figma for $20 billion in 2023, but was blocked by regulators, forcing Adobe to pay Figma a $1 billion breakup fee. However, this would also make Warner Bros. More valuable, which would force Paramount, another Netflix competitor, to finance an even larger deal if they still wanted to pursue the acquisition. I view the $5.8 billion breakup fee as a signal of Netflix's confidence in the deal obtaining regulatory approval, and I trust Netflix's management team in making their case heard. I'm confident that Netflix, with its strong business model, fundamentals, and competitive advantages, can ride the wave of risk that's heading their way. That's why I've bought more Netflix stock in my eToro portfolio, making it a 10% position and one of my top 5 holdings. That's it for this video. I hope you enjoyed. See you in the next one.